With economic uncertainty on the rise, it is more important than ever to understand how the current state of the economy may impact your personal finances. Join me today as we break down where things stand with growth, unemployment, inflation, interest rates, the housing market, and so much more. I'll discuss what the key indicators mean and how you can make smart money moves to protect yourself in these challenging times. Whether it's budgeting carefully, paying down debt, or reconsidering major purchases, you'll get useful tips for navigating the economy and keeping your finances on track. This is essential knowledge for taking control of your money and avoiding pitfalls ahead. Tune in as we make sense of the U.S. economy and what it means for your wallet. Let's jump in.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Welcome to the Financial Mirror, and thanks for joining me today as we continue to work to improve the one thing that we can control ourselves. Here at the Financial Mirror, it is not about the numbers and spreadsheets alone, but transforming and educating you on money so you can make smarter financial decisions. If this is the first time you are joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as they release. If you are listening to this on a podcast platform of your choice, don't forget to like and subscribe to the podcast. Both of those things go a long way in helping reach more listeners. If you're on Apple Podcasts or Spotify, leave that 5-star review and a written comment as we continue to spread this information to improve people's personal finances in all aspects of our life. I am excited for this episode. There's a lot happening in life right now. If I'm totally honest, I am learning how to be a parent. For any of you parents out there, me and my wife welcomed our baby into this world, and it's a learning curve to say the least, but it's been fun nonetheless. Alabama football just kicked off yesterday. Smoked a really amazing brisket, and it turned out really nice. And let me tell you this. So we were talking for lunch today. We had the brisket, right? And we had already vacuum sealed it all up. We were getting prepared to freeze some. And my wife's like, how do we reheat this? And I was like, I have no idea. So listen, if you're going to reheat the brisket after you smoked it, for all of you brisket fans out there, or maybe you're not and you just want to try this, literally, if you just boil the water and drop the vacuum seal bag in there and just heat the water up to 165 degrees and just let it soak in the water, it is absolutely to die for, right? It reheated and was still just as tender as yesterday when we had it fresh off the smoker. So it was great, absolutely great. So go ahead, try it out. If you like it, let me know. If you hate it or you have a better idea to reheat it, I do have more brisket in the freezer. So if there's any advice on how to reheat that better, please let me know. But in addition to that, I do have, I started this year. I was going to do 5 half marathons this year, and I've done 3 already. And I got 2 more coming up that I'm prepping for. There's just so much going on in life right now. But with all that occurring, right, all those things occurring, there's all these things happening, and I'm sure your life is just as hectic. There's also a lot going on in the economy, right? So with all those things going on around us, there's also a lot going on in the economy right this very moment. Okay. So we've seen the market boom, we've seen the market bust, we've seen it run sideways, we've heard about inflation, we've heard about Bidenomics, we've heard about all these things, so much more, right? But nonetheless, life is happening and the economy is happening. And this has probably led you to think about, okay, there's so much going on. There's so many views. I don't know who to believe. What is actually going on? And I said, you know what? This is great. I'm sure you can relate to this. And I was like, I need to create an episode because I've talked about this. I want to keep you informed. I want to help educate you on things you can look for, things that you can do in your personal life so that you can have a prosperous financial journey, right? So today we are celebrating the 150th episode since Financial Mirror originally kicked off years ago. And I thought, what better way to celebrate than discuss the current state of the US economy, breaking that down and helping inform you of what that means for your personal finances. This is going to be an episode that's slightly data driven. What I've tried to do is to take all these things that you hear about and boil them down into like something that's a little bit more layman terms comprehensible, so you can actually be like, oh, so that's what that means. Oh, okay. Now I get it. And just that little baseline understanding, just helping improve that little small understanding, will go a long way. When you start to hear things, you can start to put your own opinions, put your own knowledge, all to, make it applicable inside of your own life. So I truly think that this episode is impactful. Like I said, it's very data driven. However, for all the data points that I talk about, I'm also breaking them down into saying, like, here's some of the things you can look for. And if you'll pick up those key nuggets of here's what you can look for, and as I break those down, when you hear about these things, when you hear people talking, when you hear news reports, when you see headlines, all of those things happening, because they're happening, it'll make a little bit more sense, because the economy impacts all of our financial lives, right? In some capacity, and it affects all of our financial lives. So understanding where things stand is key to making some really thoughtful and well-informed, good money decisions. So that's kind of what this episode's about. I truly hope that you get a lot out of it, because it's very informative, and I'm really excited about doing it. But let me first start off by saying this. Before I jump into this episode, I do want to say that my opinions on the stock market and the overall economy today, I'm not a licensed financial advisor, so these are totally the views I'm about to express are my personal opinions and determined through independent study and research that I've done, but they should be not construed with some type of professional investment advice or how you should spend your money or what you should do with your finances. But this is strictly to educate you today on what I have independently researched and studied about the market. Okay. You should always consult a qualified professional before making any investment decisions. So let's just have a thoughtful discussion today and have that understanding, because I'm simply sharing personal speculative views for entertainment purpose and education purposes only. Okay. So let's jump in and let's first start talking about the growth of the economy. So the economy grew at 2.9% annual rate in the second quarter of 2023. Now, what does that mean? Well, it kind of means two things, and it's two things that I really want you to think about. First, that there is some deceleration ahead, and there is still this potential recession concern. We've been talking about recession. If you look right here on the screen, the last two quarters of 2022, the Q1 and Q2 of 2022 did have negative GDP growth in those two quarters. Historically speaking, back-to-back quarters of negative GDP does signify a recession. Okay, just historically speaking. Now, what this means for us now is that we have deceleration and potential recession concerns still going on. You can see right here on the screen 2023 and the end of 2022, Q3, Q4, Q1, Q2 have all been positive, which is great. So that's the first thing. That's great. But we are seeing some slowing. If you see that trend, it is going down, and there is some slowing expected as high inflation and rising interest rates are starting to scale back spending. Okay. This does lead to the idea of a recession, right? So we do see deceleration because GDP growth was 2.9% in Q2 of 2023, and that's kind of down a little bit from previous quarters. Okay. However, I do want to talk about this risk of recession. So we see that. We see GDP growth is something that we should monitor and look at, but we do still have the risk of recession. And that's kind of what I want to talk about. I want to talk about, because everyone else is talking about recession, and I kind of want to talk to you about that. Some economists out there are warning us that there is an elevated risk of recession as the Feds continue to, raise rates and try to combat inflation. But we are currently in a season. We're in a season, and that's what this image it visualizes, and hopefully for those on podcast, I can walk through this. But how this sort of flows is this expansion to recession phases. So sort of that, thinking about this from like a seasonal perspective, like spring, summer, autumn, or spring, summer, fall, winter, or spring, summer, autumn, winter, whatever you want to call it. Keeping that in mind, that's how I want us to think about the economy in this sense. That expansion kind of begins when we had some lost jobs and they're starting to come back, and it's like the leaves are starting to come back on the trees, all those things, right? Like that's kind of this continuum. Like the jobs are starting to come back, consumer spending is starting to pick up, the markets are starting to rebound a little bit. And that's kind of that spring that, everything's starting to blossom and flourish and all these things, right? And then we get to the summer, and that is where it heats up. It really heats up. It gets hot. It gets hot, right? We like the heat. Wages are going to accelerate. Profit margins are going to peak. Businesses are just booming, right? Employment is out of control. Inflation is at a very comfortable rate, right? Like that's like getting in the AC. That inflation is just nice and comfy in that super, super hot market. But the markets are gaining. They're gaining. They're getting smoke hot, right? But then we get into this autumn, this fall. Things are starting to slow down. Job growth is slowing down. Inflation is starting to accelerate a little bit. Spending is slowing down. All of these things, profits are declining. We are in an autumn-fall time frame, right? We are in an autumn-fall time frame. And the idea here is that we've got to, at this point, and I'm going to talk about this in the next little part of this, so I don't want to get too deep. But we are at a very pivotal point right now in the economy as we're in that season of fall. There's things that are happening, but there's also there's a chance of recession. That's what I'm getting to. There's a chance of recession. There's a chance. There is still a chance that we don't fall into a recession. We don't experience a rough winter. Okay. There's still a chance of that. But some economists out there are warning that there is an elevated risk, right? There is an elevated risk. The timing and severity is highly debated because nobody really knows. Like we're trying to see what's going to happen, but nobody really knows. One thing that I can tell you that I would challenge you to look for is, you can see right here, one of the key points of this is that profits are going to decline. We are currently in an earnings season. So I would be on the lookout for how companies are reporting their earnings. If companies are missing earnings reports, like they said that, we're going to have XYZ revenue this quarter, and they're missing that, like millions off, right? That begins to point to me like, yeah, recession is possible, right? Like profits are just not there. Like they're declining and they keep declining. Like we're getting in a tough position. We're going into a tough winter right here. Just keeping our seasons at the top of how we're discussing this. We're in a tough season because earnings for a company is showing how consumer dollars are being spent or not spent, right? So we saw that, and we're seeing that as companies are reporting earnings. Some are reporting good right now, but we're kind of in that earnings season. And I would challenge you to look at those companies, those big companies that are reporting earnings, because those big companies should give us a good guide to how are consumers currently spending their money. And that's a good indicator, Now, in addition, like I said, we saw 2 consecutive quarters of GDP growth, a negative GDP growth at the end of 2022, but we haven't really seen those negative, or Q1 and Q2 of 2022, but we haven't really seen those as of yet. Okay, as of yet, we haven't seen that. So I would keep watching that. In the show notes, I'm going to put a link to that .gov site that I pulled that chart from on the previous slide. Feel free to go back and look at that and continue to watch that. And if you start seeing that GDP growth declining and getting down back to the negative, that's where we would start to be slightly concerned, right? So we got the company's earnings coming out. Those are not very, very hot. If the GDP growth continues to decline, I would start being slightly more concerned. Me personally, being slightly more concerned. So When speaking of recessions, like we were looking at this, if we go into a recession, we could go into a recession and it could not be bad. We could go into a recession, it could be absolutely awful. What we don't know is how severe it will be. But when we're speaking of that, you're probably wondering, what are the chances? What are the chances? Well, as of right now, economists have very, very wide range of variability of what that's going to be, but it ranges anywhere from a 30 to an 80% chance of a downturn in the next 12 months. Timing and severity still is highly debated. So here's what I would tell you. I would tell you, don't get super caught up in what economists are saying. I would look for those simple things. And you as normal human beings that are not just living, breathing, and trying to influence these type of decisions that are going on. What we need to be on the lookout for is what we can visualize without putting a ton of time and effort into it. And that's earnings companies are reporting and watching that GDP growth, to see if that continues to come down. So what's being done currently? I told you and I alluded to things are being done, but what is being done currently? Well, what is currently being discussed is the Fed is trying to engineer this quote unquote soft landing, right? They're trying to land the plane softly. We have this booming economy, the summer. Remember the summer month that we just discussed? The summer month was red hot. It was just, burning up. And now the plane's trying to come in for a nice, smooth, soft landing. They're trying to bring down inflation without going into a super hard winter, that recession. And I'm trying to speak in those seasons because I want you to think about that continuum that we saw. That think about like a for those on a podcast, think about like the sun rising, peaking, and setting. It's kind of like the sun rises in the spring, peaks in the summer, sets in the fall, and what you don't want is a super bad winter. You want to kind of get back to that spring, summer, fall rotation. No bad winter. That's what we're looking for. We're looking for no super, super harsh winter. So a soft landing, that is the ideal scenario that is trying to be achieved. And what they do for that is they gradually raise interest rates, and what that does is slow down buying. Now, I try to think about this and describe this in a way that you can begin to understand, what does a soft landing look like? What does that actually mean? So I came up with this little scenario to throw together to just walk you through kind of what that means and try to give you a visualization of what does a soft landing actually mean. So here's what I want you to think about. Look at it like tiers. So every time the Feds raise the interest rates, normally like 0.25, 0.5% or whatever. But every time, think about it like tiers. Every time that the interest rate goes up, every time that the price goes up, you eliminate a certain percentage of buyers. Okay. So every time it goes up, you instantly eliminate a certain percentage of buyers. So think about this, for instance, let's visualize a house is for sale. I'm a seller and I'm trying to sell my house, put it on the market for $100,000. I put my house out there for $100,000. And let's say that as soon as I put it out there, pops on Zillow, I get 10 offers out the door, 100,000. And I'm like, oh, okay, 100,000. Cool. 10 offers. So I'm like, you know what? I want to sell it for more. So I bump it up to $125,000. Still people wanting it. Still got people wanting it. I get 7 offers. Now you can see we're starting to slow down. We started at 10 offers at 100, bumped it up to 125, and now there's only 7 people that want this house now. I had 7 offers. Previously 10 for the same house, right? Like not worth this much. All of a sudden, price gets raised to 150,000. Now I'm down to 3 offers. You see what the issue is. Every single time there's an increase, the amount of buyers that are interested decreases. Sometimes that is, if we're talking about a house, we could be talking about demand, right? Like people are just like, oh, that house isn't worth that. I'm just trying to give you a visualization. I'm not saying this is reality, right? This is not, if the house was 100,000 and you tried to bump it up to 150, I think you would end up losing all your buyers. But unless it was worth that. But just a visualization, price hits 150, you're down to 3 buyers. Here's the issue, is that when we bumped from 125 to 150, there was no guarantee that we were going to even have a single buyer left. There was no guarantee. All 7 buyers could have walked away and said, yep, not spending my money. They could have happened. But what we were banking on is that we were going to increase it just enough that we would still have some interest. And I did, right? Was going to sell for 150 and I got 3 offers. Now, looking at this trend, the first time we bumped it up, we lost 3 buyers. This next time we lost it up, we lost 4 buyers. There's a good chance that those 3 buyers, if I try to bump it up to 175, I'm dropping to 0 buyers. Nobody's going to want my house. And what that signifies for us in this example is that recession. You've eliminated all of your buyers and you have stalled the market. You've absolutely stalled the market. And that's what the feds are that's what they're trying to prevent. That's when we think about soft landing. It's to bring down the inflation, right? Inflation is caused by this increased pressure, this hot market, right? We drive all this stuff up. And we need to bring that down very softly, that soft landing. And that's what we're trying to prevent. So if we got to 0 buyers, we've stalled the market. House is not selling, right? Nobody wants it. But that's kind of what we're looking for. The feds are trying to get to a 2% target without really sharply contracting the economy, because they could. One single hike, one single 0.25% interest rate hike could be like, all the buyers could just be like, yep, not doing it, or at least a majority. And if a lot of the buyers are tapping out of the market and money's not circulating, we got a problem on our hands, right? So that's something I would be looking for. Every time you hear about these Fed rate hikes, think about that as in this example. Think about that house price bumping up a little bit more with the potential that nobody's interested, right? That people are, we can put it on the economy. That's the economy saying, now it cost you this much. And then everyone's saying, yep, not interested in your economy, holding on to my money, not spending it, right? And now you're in trouble. Now you're in big trouble. So that's what I would be looking for. A soft landing is super difficult to achieve. But if it is successful, it could mean tighter monetary policy that can help like sort of rein in inflation. But they are trying to literally thread a needle, but the risk of a hard landing still remains possible. The risk of a harsh winter still remains possible. Okay. Still remains possible. Just don't know what it's going to look like. So keep those things in mind as we're thinking about this recession, as we're thinking about this growth, as we're thinking about this deceleration of the economy. Watch GDP, watch consumer earnings, watch every time that you see another Fed rate hike conversation happen, watch what happens to the market. See what's happening. Those correlations will help you determine what way we're headed. Next thing that we want to keep in mind of is unemployment. The unemployment rate, I'm not going to spend much time on unemployment because the rate was 3.8% in August 2023. This does remain historically low for all intents and purposes, right? So the job market is cooling off. It is still strong, but it is cooling off. The pace of job growth is still kind of moderate. We do see layoffs starting to tick up in like the tech and housing sectors. But all in all, unemployment rate is staying kind of constant, not really increasing, not really decreasing, kind of just moving sideways over the past few months. Pre-pandemic, for a lot of these examples, I'm trying to get people to start seeing that pandemic thing is over. Like that iteration is kind of over for many aspects of our lives. We're kind of getting back, and I just want to try to help that narrative in all intents and purposes start to realize that we're kind of back in that ballpark. So you can stop having that mental perception of like, oh, well, pre-pandemic this, pre-COVID this. I'm trying to help flatten that, right? I'm trying to help, get rid of that so you can see we're kind of still on track. We did have this like weird thing that happened in a few years, but we're kind of getting back into the rhythm of things. So pre-pandemic, January 2020, we were at 3.5%. Right now we're at 3.8%. The one thing I do want us to highlight about unemployment, though, is just wait. Just wait. Because just like we discussed with recessions, if companies do start to show they aren't hitting their earning targets, we could see an uptick in unemployment rate, right? If we start getting to that harsh winter, you're going to see an uptick in unemployment rate. If you start having that fall season, that autumn season, that companies are not reporting very good earnings, you're starting to see a GDP growth is declining. Companies need to cut costs, and what is the biggest way companies normally cut costs is people. So we'll start to see that decline. We'll start to see that roll back. So I would highly encourage you to watch the unemployment rate. This is another it's sort of a trailing indicator of what's happening. But once this starts to happen, and once people start getting laid off to cut cost, then we could be at an interesting moment. So if you start to see your unemployment go up, that could signify that there's a little bit of something going on. There's something there. I wouldn't just say, oh, we're in a recession because unemployment went up. No, I wouldn't do that. But I would start to be a little bit more. I wouldn't be as optimistic. Many reports do show though that the unemployment rate could end 2023 around the 4.1 to 4.5%. So just be on the lookout for that. Currently at 3.8, but you can see right here, April of 2020, when a huge number of layoffs happened during COVID, it was up around 14%. So just over 14%. So big changes. We made drastic improvements. We've opened up a lot of jobs, but just know that we are in a good position for that so far. Next thing is inflation. Inflation does remain high. It has somewhat cooled off from that high early, the 9.1% back in June of 2022. Currently, inflation is sitting about 3.2%. Like I said before, the Feds are trying to get it down to 2%. But you're probably thinking, dude, what? We're at a 3.2% and we're trying to get to a 2%. And I feel like all of my money is gone. I feel like it's all gone. Well, let me just, there are some facts that I do want to present to you. This does not tell the whole picture. If you're familiar with reading the Consumer Price Index at all, there's categories, and it's an average of all the categories. Most of the time, when we think about it, there are certain things that sway your average to make it realize that consumer-wise, you are still paying a lot more than you were. So what I did for this little segment is I kind of wanted to break it out, is like, this is the comparison, because you're probably still in that pre-pandemic, post-pandemic mindset. So I broke this out into pre-pandemic, post-pandemic mindset. So pre-pandemic, CPI or inflation percent was 2.5%. And right now we're at 3.2%. Okay. So there's your comparison. We're already slightly higher, but that's where we're trying to get that gauge back. Now, here's the part that really matters. Here's why you still feel it. When you think about like my prices are still high, here's why you still feel it. Currently, housing, shelter in this case, is at 7.7%. Pre-pandemic, it was at 3.3%. So it's over 4% higher for shelter or housing, right? Mortgage and rent. Food at home, also called groceries, currently it's at 3.9%, 3.6%, and pre-pandemic it was at 0.9%. Okay, big difference there. Big difference. 3% difference there. Electricity is currently at 3%. Pre-pandemic, it was at 0.5%, so about a 2.5% increase on electricity, and all your other utilities. Currently at a 6.1%, and pre-pandemic is at 3.1%, so another 3%. So you can see a lot of these things are 3% higher than they were pre-pandemic, while the overall looks to be like, what was it, 3.2 versus 2.5? Yeah. So very, very much bigger than that is what you're feeling in your actual pocketbook. Okay. So those are the actual facts, and that's what I like to present people with, is that don't look at the one, look at the individual categories, and you can really start to identify where these things are painful. And a lot of this is painful. So that's the first thing. The next thing I did want to hit on really quick was interest rates. We are seeing the Feds raise interest rates. Currently, they've raised them 11 times since 2022, sitting at a 5.25 to 5.5%. This is a 22-year high for interest rates. Big deal. Economists are predicting that this is like most likely there won't be another raise by the end of 2023. Could happen, but what can you expect and what should you be on the lookout for? I would continue to watch these rates. Going back to my example about talking about the house prices with the seller and the buyer, every time it's raised, there is a chance that tips us into a recession, that it stalls the market, the economy stalls out. How the market reacts to these changes will determine future state. So keep an eye out. We just had this one get raised on July the 26th. We could see something start to pan out with it, but as of right now, it doesn't look like that's the case. So we'll see what happens with our inflation and see if that starts to come down or not. In addition to that, the mortgage rates are currently at a 7% on a 30-year mortgage. Pre-pandemic, they were around 4%. So we are higher than pre-pandemic. However, 7% back in the early 2000s was the norm back then. Like that was kind of what it was at in the pre-2000s. So I say that to say we've been here before. Like this isn't like unfound new territory. We've been here before. So don't freak out. Don't let them. And when they say, oh, the mortgage rates are so high, like blah, 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 like don't let it freak you out. We've been here before. And always keep in mind that back in the 1990s, a 14% rate was kind of the normal. So keep it in mind, it's all about perspective. 14%, and now we're at 7%. So it's like you're getting half off on your mortgage rate right now. So from the people in the 90s. Now I really quick as I wrap this up, I do want to end on my favorite, and probably your favorite too. And then I want to give you some things that you can do for your personal finances, a couple of money moves that you can make to ensure that you're on track no matter what happens with the market. So stocks is the last one that I kind of wanted to hit just so you can sort of see what's going on. We are currently, the market's kind of in a sideways channel. I would not be looking at the daily results of the market. Like if you're looking at it every day, the market's super volatile and is expected to remain volatile. So you're going to see every time interest rates and inflation data and recession risk and all those things get talked about, you're going to see some kind of sharp swings. Here's what I would say. Here's what I'm going to tell you. I put a couple marks on here. You can see Morgan Stanley has a projection of 3,900 for the S&P 500 at the end of 2023. Goldman Sachs has an estimate of 4,000 for the S&P 500. Also, not much higher than Morgan Stanley. Now, most expect, no matter what you look at, very limited single-digit returns for the year. If you're looking at that, so very single digits. Normally we get maybe a 10% return. This year you're going to get a very small single-digit return more than likely. Now, earnings growth will slow if the economy. If the earnings are going to slow as the economy is slowing, so that's going to potentially impact the equities, things like that. What do you need to look for? And that's kind of what I wanted to end this section with, is what should you look for? So we've talked about for the overall market, we've talked about the GDP growth. We've talked about the earnings of the company. We've talked about watching that unemployment rate and see if it starts to tick up, exponentially. We've talked about the making sure that you're watching the inflation rate, those individual categories, to start to understand that consumer price index and where that actually is going. But and then we talked about housing interest rates so that you can get a good understanding. 7% will price some people out of the market of buying a home. I understand that it will, but that's kind of the point. Thinking about those tiers, certain people are going to get priced out at certain points. The whole idea is that it doesn't tip it into stalling it out completely. Now, what should you be looking at for stocks? Just like I started this with, this is not trading, buying, investing advice. It is simply my observation. Trading stocks involves risk of financial loss that you should be prepared to bear. If that happened, I will not be held liable for any losses resulting from your investment decisions based on this very informal analysis that I look at just for me to try to come up with an opinion for what I think is going to do, what I think the market's going to do. So now I got the legal part out of the way. I'm not a professional financial advisor. Please don't take this as financial advice. This is just my personal opinion. Okay. Just my personal opinion. Education purposes only here. So legal part's done. Currently, I see a range of around 4,300 to 4,800. That's kind of the range that I see. And you can see here on the chart, my opinion low, my opinion high. That's kind of what I'm looking at. That's the range that I'm thinking for the end of 2023 that we're looking at here. I do see a pullback occurring over the next few weeks, right? I do see a pullback occurring over the next few weeks. So you could start to see some red days moving into the next few weeks. If the price gets up to 4,600, which is currently at 45.15 as of close on Friday, if it gets up to 4,600 and breaks out of 4,600, meaning it gets through 4,600, that's where I would start to look for a nice run up that could potentially run up to 4,800 by the end of the year. Okay, that's the first thing. The second thing, if that 4,600 holds the price there, this could roll back over and pull back to that 4,300 area or even that 4,000 area, like the Morgan Stanleys and the Goldman Sachs have projected. So they are leaning more towards a bigger pullback, maybe that 4,600 getting rejected. But I do say all that to say I'm still optimistic about the market. I would not panic. I'm just providing these views for what I see personally and to give you just some reference points to make your own determinations. The last thing that I did want to talk about was the impact on personal finances and a couple things that you can do. First off is budgeting. You've got to get a budget. If we're going to go into a recession, even if we're going to have a very constricted market, budgeting, cutting discretionary spending when you can, focusing on your needs versus your wants is vital. Super duper vital. You need to increase your savings. Emergency savings is crucial. You never know what could happen. Job losses can happen. Cuts in work time could happen. Lots of things can happen. Increasing costs can happen. You need to be equipped with more savings for the unknown times. Debt pay down. It is harder to withstand financial turbulence when you have debt. When you owe an extra $500 a month to a creditor, it is much more difficult to withstand financial turbulence. So you've got to work on debt pay down. Focus on these things. Investing. Down markets equal great entries, right? Down markets equal great entries. If you're out of debt, start putting some money into your investments. It is a great opportunity for you to watch that money grow and give it a much longer runway to grow. And then the last thing is major purchases. These can bite you in the tail if you don't plan them well, right? If you buy something huge, you buy a huge purchase and you get stuck with it, especially if there's a payment or something on it, which hopefully you're not going that route. But if you do go into a big purchase and then all of a sudden the market does begin to move us towards a recession or something of that nature, it could bite you in the tail. So I would tell you to hold out, until we get a little bit more stability if you can. But I'm not telling you not to buy any major purchases. Definitely not saying that. Just saying be cautious. Be cautious about it and think hard about it. Now, last things that I would tell you to watch for is watch if inflation does what is expected, meaning it starts to trend downwards toward the 2%. If not, you could see more rates hikes happen, and that could tip us into that no more buyers for our house we're selling. And then if a recession hits, I would be watching how severe it will be in terms of unemployment, market downturn, things like that. Just a couple things I would look for. But remember, all in all, stay positive. Stay positive. There's a lot of good things happening. Just remember, stay positive, keep your head up, and you will be headed in the right direction. Market might show red. Market might be flashing red, blowing you up with saying everything is, chickens are, what is it? The sky's falling is Chicken Little's little thing, right? Like sky it might look like it's falling. Stay positive. Stay positive. Focus on those money moves, the budgeting, the pay down the debt, the increase your savings. Invest when possible if you're out of debt. Avoid major purchases as much as you can. All those type of things will help you ensure that you are equipped and ready if there is some financial turbulence ahead of us, right? Now, if you are ready to take control of your finances and you do want to get a little help along the way, I do serve as a financial coach, and I'd be happy to work with you. Head over to thefinancialmirror.org. and hit book now in the middle of the screen, and I will be happy to set you up with a free consultation just to see if a financial coach is right for you. If it is, we'll get you set up on a plan that works for you and towards your financial goals, whatever those are. We'll get you on a perfect plan for that. If you do want to get a little extra dose of support, head over to thefinancialmirror.org/shop and pick you up some awesome Financial Mirror gear. I truly hope that you enjoyed watching this video today. I appreciate you tuning in. If you have not already, hit the subscribe button to subscribe to the channel, like the video, comment on the video, and just share it with all of your friends, family, coworkers so that you can have a community around you of people that are just trying to improve their personal finances. Great for accountability, great for continued learning of your close-knit group of folks. If you listen on a podcast, thank you, and don't forget to subscribe and leave a 5-star review and a written comment on that podcast. Truly goes a long way. Till next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.